Markets didn't crash because of a recession. They crashed because Donald Trump demanded $900 billion in cash from America's allies. Overnight, Washington turned friendship into a collection notice. Japan would have to liquidate nearly half its foreign reserves just to comply. South Korea warned the payment could collapse its entire economy. And as U.S. allies scrambled for dollars, Beijing made its move. Reuters confirmed China's Treasury holdings have plunged to the lowest level since 2008, while foreign inflows into Yuan bonds surged for the first time in years. The world's biggest creditor isn't just dumping U.S. debt, it's quietly flipping global investors into its own currency. In a single week, the financial order that's held for 80 years began to invert. America's closest partners are running out of dollars, and China is offering the lifeline. If that shift continues, the dollar won't just lose its crown, it'll be overthrown in real time. In Japan, emergency meetings began before sunrise. The Japanese finance ministry calculated that if it honored President Donald Trump's demand for $550 billion in upfront investment, it would have to liquidate nearly half its treasury reserves, an amount equivalent to 41% of total foreign currency holdings. Reuters quoted senior officials saying the move would risk destabilizing Japan's sovereign balance sheet. The question quickly emerged. Was the U.S. asking its closest ally to finance American industry at the cost of its own financial security? Seoul faced a similar ultimatum. South Korea's national security advisor told reporters in late September that Washington's request for $350 billion in cash was unsustainable given our reserve levels and would trigger economic crisis if executed. Reuters documented the fallout as the Korean won weakened past 1,400 per dollar, its lowest in more than a year, attracting speculative pressure from currency traders. A hypothesis emerged. By pushing allies for tribute-like payments, Washington was destabilizing their currencies while inadvertently making China's yuan appear more stable by comparison. In Beijing, the State Administration of Foreign Exchange approved new channels for foreign investors to access China's bond market. On September 30th, Reuters confirmed that China opened its equity options market to global institutions for the first time. This wasn't an isolated gesture. The People's Bank of China had already widened swap lines with regional central banks, giving them easier yuan liquidity during dollar stress. Logic suggests a coordinated push. If the U.S. compels allies into unsustainable outflows, China offers them an alternative corridor to park capital. Wall Street noticed. By March 2025, foreign investors had accumulated 1.14 trillion yuan in negotiable certificates of deposit, the highest on record, lured by hedged returns of nearly 5%, stronger than comparable U.S. Treasuries. Reuters cited traders saying, if the world wants yield and liquidity, yuan assets are becoming the option. Here lies the testable claim. Is the yuan attractive because China reformed its markets, or because U.S. policy forced investors to look elsewhere? Hong Kong amplified the pivot. Bloomberg reported in July that China considered doubling the southbound Bond Connect quota to 1 trillion yuan, granting domestic investors larger access to foreign bonds via Hong Kong. That two-way channel means China can recycle surplus savings abroad while attracting inflows into its own markets, a dynamic once monopolized by the dollar. If the mechanism succeeds, global liquidity itself may rotate between currencies, not just assets. Meanwhile, the U.S. Treasury Department faced a credibility crisis. Leaked memos revealed Secretary Scott Bessent warning that without Japanese and Korean pledges, Washington's funding gap could hit $200 to $300 billion. His public assurances that China would not weaponize treasuries, as reported by Reuters in April 2025, rang hollow against data showing Beijing's positions shrinking month after month. The contradiction sharpened. How can Washington demand cash from allies while the largest holder is exiting quietly? Halfway through the year, a fact reset the narrative. Bloomberg reported that in the second quarter of 2025, China experienced net foreign inflows into its onshore bonds and equities for the first time after months of outflows. This reversal forced analysts to abandon the assumption that China was bleeding capital. Instead, capital was returning. Why? Because foreign holders of U.S. assets, disillusioned by volatility and political pressure, were reallocating into yuan assets. That midpoint revelation reframed the crisis. What looked like China retreating was actually China flipping global capital flows in its favor. From that moment, the urgency deepened. By May, Reuters reported China's Treasury holdings had dropped again to $765.4 billion, down from $784.3 billion a month earlier. Each decline is incremental, but the direction is unmistakable. The IMF circulated an internal note estimating that if even 10 to 15% of global reserves transition from dollars to yuan over the next 5 years, U.S. borrowing costs could rise 50 to 75 basis points. The scale is material. Every basis point costs billions in additional interest on America's national debt. Yet, evidence also shows China remains cautious. Analysts noted that Beijing still holds $750 billion in treasuries, too large to liquidate without harming itself. This demonstrates the hypothesis that China seeks a gradual flip, not a sudden rupture. The strategy seems to be stabilize yuan channels, widen investor access, and let Washington's demands on allies accelerate the transition naturally. Japanese 10-year government bond yields jumped 15 basis points the week Trump's $550 billion ultimatum hit headlines. Reuters described it as the sharpest move since the Bank of Japan began yield curve control. Investors speculated that Tokyo might be forced to liquidate treasuries, which would raise U.S. yields even further. The risk is recursive. U.S. pressure on allies produces sales that hurt America's own borrowing costs, creating exactly the vulnerability China appears ready to exploit. In Singapore, sovereign wealth funds quietly increased allocations to Chinese interbank debt. Memos cited by Reuters in March described yuan assets as offering low correlation regimes and haven appeal. These aren't ideological choices. They're portfolio reallocations based on risk-return math. A hypothesis emerges. Even if central banks resist geopolitically, their asset managers may shift gradually into yuan for financial reasons alone. South Korea's parliament raised alarms of its own. Lawmakers calculated that transferring $350 billion would equal 83% of total reserves, essentially bankrupting the country's capacity to defend its own currency. Reuters quoted one member asking, "Why should we drain our economy to grow America's?" The debate mirrors a Roman dynamic, tribute flowing to the capital, yet without the guarantee of protection. Hypothetically, if Korea balks, China could step in as lender of choice. In the U.S., quantitative hedge funds reversed their core positions. Instead of shorting Chinese credit, they began buying yuan-denominated credit derivatives while selling long-dated treasuries. The CME reported a 15% jump in implied volatility for USD CNH options in mid-2025, a sign of hedging pressure. The implication is that markets themselves, not only governments, are starting to prepare for a regime shift in global capital flows. Across Asia, China deepened infrastructure. Shanghai's exchange unveiled a framework enabling private firms to issue 37 billion yuan in bonds under stricter disclosure rules, with underwriters guaranteeing liquidity. Reuters highlighted this as Beijing's answer to Wall Street's dominance in secondary markets. If liquidity, the key weakness of Chinese bonds, improves, global asset managers will face fewer reasons to avoid them. Seoul considered alternatives. Officials drafted contingency plans to diversify reserves into euros and yen while trimming dollar exposure. Simultaneously, Beijing injected 100 billion yuan through a cross-border repo into Hong Kong and Singapore, narrowing spreads between onshore and offshore yuan. The move allowed global banks to arbitrage more easily, integrating yuan liquidity into mainstream markets. The hypothesis arises, are investors flipping because China is pulling, or because Washington is pushing? The evidence suggests both. Tokyo's political factions split. Some argued the U.S. alliance required compliance. Others warned that surrendering $500 billion would hollow out Japanese industry. Reuters quoted a senior candidate insisting Japan must stand its ground if terms are unfair. The unresolved question, can Washington impose tribute without eroding the very alliances it depends on? Late in September, Reuters reported that China's yuan appreciated nearly 2% against the dollar in the first half of 2025, even as exports continued to rise. Normally, a stronger currency hurts exports. Here, it did not. That anomaly challenges the assumption that China needs a weak yuan to stay competitive. If exports remain strong while the yuan rises, the entire framework of dollar advantage is undercut. In London, traders watched order books swell for Chinese IPOs. A precious metals miner raised $3.2 billion in Hong Kong, shares surging 68% on debut. Each IPO siphons capital that might once have flowed to Wall Street. The testable claim, Trump's tariffs may be accelerating China's capital globalization instead of slowing it. At 10 p.m. in Beijing, a senior PBOC board member stared at the yuan index in silence. The data told a story no one dared to announce. Foreign inflows climbing, swap lines widening, trade settlements shifting, and global funds quietly pouring into Chinese assets. Breaking the stillness, he asked his aides, "Are we watching the financial world tip over?" without anyone saying it out loud. Across the ocean in New York, a young trader whispered at his screen, "We're not defending the dollar anymore. We're just trying to get out first." That's where the crisis loops back. Not to a crash, but to a question no central bank can answer. If investors start treating Yuan bonds as the new sanctuary while Washington shakes its allies for cash, how long before the dollar stops being a safe haven and becomes the risk itself? We're glad you're enjoying this video. Please like and subscribe, and check out another video that is now on your screen.